Could a new recession be looming on the horizon of the U.S. economy? This question has been the subject of much debate among economists, financial analysts, and investors alike. The answer, however, is not as clear-cut as one might hope. Economic forecasters often find themselves divided into two distinct camps. On one side, there are those who view a recession as an inevitable part of the economic cycle. They argue that the factors leading to a recession are already in motion and that it's only a matter of time before they culminate into an economic downturn. A recent survey by Bank of America supports this view, revealing that 65% of global fund managers anticipate a weaker economy, with many moving their assets into cash as a precautionary measure. On the flip side, there are those who believe that a recession is not a foregone conclusion and that it can be averted with the right policies and actions. They point to positive indicators such as a robust labor market, high retail sales, and an excess of savings in the economy as signs that the U.S. economy is resilient. The Federal Reserve Bank of San Francisco, for example, estimates that there is still around $500 billion of excess savings in the economy. However, predicting the exact timing of a recession is a complex task. Failing to accurately forecast the onset of a recession can lead to significant losses for investors and financial institutions. Conversely, accurate predictions can enable stakeholders to take proactive measures such as adjusting investment portfolios, strategic planning, and adopting prudent risk management practices. Our own CMI model of the business cycle suggests that a new U.S. economic recession is inevitable. Despite measures like dramatic interest rate cuts, the model indicates that these may not be sufficient to ward off a recession. Instead, they could lead to a short-term rally in the financial markets, but ultimately deepen the impact of future financial crises. The model suggests that the Federal Reserve may need to resort to non-standard monetary policies, such as quantitative easing, to stave off a recession. However, the high rate of inflation could make it challenging for the Federal Reserve to effectively implement such policies. In summary, the prospect of a new recession in the U.S. economy is a contentious issue. While some economists argue that a recession is inevitable, others believe it can be avoided with the right measures. The key lies in accurate forecasting and proactive strategic planning. Regardless of which camp one subscribes to, the importance of preparing for potential economic downturns cannot be overemphasized. After all, in the world of economics, it is always better to be safe than sorry.